past month and a half, we've seen what happens when the most alluring group in the Wall Street fashion show suddenly goes out of style. I'm talking about the high-flying cloud-based software stocks that have just been slaughtered in recent weeks. Some of these names have been hit harder than others. Zscaler was well over 100% for the year at its highs. Now it's up 21% for the year. Whew. The Cloud Kings, Adobe, Salesforce, ServiceNow, Splunk, Twilio, VMware, and Workday, they're down on average 18% from their highs. Of those, only Adobe and Salesforce have shed less than 10%. Now, I love many of these software service companies, you know that, but this is why I tell you that you have to take some profits, some schnitzel, I call it, in your biggest winners while you still have them. Momentum stocks can go from heroes to zeros practically overnight, especially because they all tend to trade together. Many are baited together by silly ETFs that should never have been crafted. As I told you before, I think there are two things going on here. First, many of these cloud stocks simply got way too expensive. That's why I kept telling you to let them pull back before you pull the trigger. Second, this market got hit with a powerful rotation. As money managers started feeling more bullish about the economy, they sold the cloud stocks and they swapped into more cyclical names that can deliver gigantic earnings beats when commerce is strong. The cloud cohort can deliver great numbers even during a slowdown. Hey, but if there's not going to be a slowdown, that makes their stocks less attractive in the eyes of Wall Street. Hence the hideous multi-week breakdown, many of which stocks you've commented on in Twitter. I know you're depressed by it, but here, maybe we can shed some light on it. Which brings me to the big question. Now that this group has been bludgeoned half to death, what are we supposed to do? You got to remember, with a few exceptions, the fundamentals really haven't changed at all. Our favorite cloud companies are still putting up excellent numbers. The market's just starting to judge these numbers through a much more punishing prism, which means we need to be more selective. So tonight we're helping you figure out which cloud stocks to double down on to weakness and which ones, well, maybe you got to cut loose some of. We know this whole group has gotten a lot cheaper over the past 6 weeks, but we need a way to distinguish between the high-quality names that have been dragged down by the rotation and the lower-quality names that never should have been up in the first place. When you make these kinds of decisions, you need to be ruthlessly logical, not emotional. I always tell you to check the emotions at the door. We're in triage mode right now, and that means we need to be as objective as possible. That's why we put together a simple screener for the software as a service stocks. We're going to run our whole cloud universe through these two filters. One is for fundamentals, and one is for valuation. Anything that passes both filters, well, then you got my blessing to buy down here after the big sell-off. Basically, we're doing a quick and dirty analysis of the cloud stocks to separate the wheat from the chaff, and this is done by real portfolio managers every single day. I want to teach you how to do it at home. It's a quick and dirty rule of thumb that Wall Street's been using to assess the enterprise software stocks for ages. You know what it's called? And I've only heard it once among our guests. It's called the Rule of 40, and it's quite simple. If you're running a software as a service company, the Rule of 40, here it is, the Rule of 40, says that your revenue growth plus your profit margin should be greater than 40%. If it's below 40, you're in trouble. Again, we're in triage mode here. We want a simple rule that tells us which of these cloud stocks need to be amputated from our portfolios. I like this Rule of 40 because it recognizes that there are two ways to win. The healthiest cloud stocks are either growing very rapidly and losing money, or their growth is slowing, but they've got increasingly strong earnings. If a company has, say, 30% revenue growth and a 20% profit margin, it passes the test. If it's got 70% revenue growth and a negative 20% profit margin, that also passes. However, if you're only growing at a 50% clip and you got a negative 15% margin, well, wait a second. That's 35% combined. It falls below our Rule of 40 threshold. Like I said, it's a quick and dirty way to look at things. But this is how venture capital firms and hedge funds and companies themselves like to assess the trade-off between growth and profitability that we talk about every night here. Now let's put it into practice. Revenue growth is straightforward. Remember, that's just the sales line. But there are a lot of ways you can measure margins, some more generous than others. Because we want to keep it simple, we're using the adjusted earnings for interest, taxes, depreciation, and amortization, or EBITDA margin. So who passes and who fails? All 7 Cloud Kings pass, mostly with flying colors. Twilio. You know, how much should we like Twilio? Twilio is the highest scores. The company's expected to grow at a 72% clip this year, further bolstered by a 10% EBITDA. So this is our winner, okay? Really terrific. Adobe comes in second with only a 24% growth rate because it's much more profitable, with a 44% EBITDA margin, reports this week. I think it could be very, very good. and that's Thursday, just so you know. Now, after the Cloud Kings, the quality really starts to drop off. Our Cloud Princes, Atlassian, Coupa Software, HubSpot, New Relic, ouch, Okta, they don't fare as well. Neither New Relic nor Okta makes the cut. Even before New Relic gave a disappointing forecast this morning, their slowing growth was a problem. Okta, on the other hand, is growing at a 41% clip, but its negative 9% EBITDA margin drags it down, so it doesn't deserve the praise, at least on this method. Hey, how about the rest of the cloud stocks? We've talked about Paycom, Viva Systems, Alteryx. We had them on last week. RingCentral, Zendesk. We've had them on. Five9. We've had Zscaler, MongoDB, Smartsheet, Anaplan. Boy, we have Appian. Less than half of them make the cut using this year's analyst estimates. Paycom, Viva, Alteryx, RingCentral, and Zendesk pass. Five9 and Zscaler would pass on last year's numbers, but they fall a little short on this year's estimates. Call out a pass, too. Everything else, we're cutting. Hey, what about the cloud IPOs from the class of 2019? I mean, you got Zoom Video, CrowdStrike, Dynatrace, Slack Technologies, PagerDuty, Phreesia, Tufin Software, and Cloudflare. We looked at 32 stocks for this analysis, and Zoom Video has the best score. Zoom, which helps explain why it's been such a great performer. We had them on last week, right? Even though it's pulled back of late. CrowdStrike passes. Dynatrace failed last year, but it passes on this year's forecast thanks to accelerating revenue growth, or ARG. Everything else must go. Which brings us to the second screen, valuation. Again, we want to keep this simple. So I'm failing anything that trades at more than 10 times sales, unless we can come up with a very good excuse. 10 times sales, by the way, very expensive as it is. Looking at the Cloud Kings, Adobe and ServiceNow are both over the line at 10.4 and 11 times next year's earnings, next year's sales. And boy, I'll tell you, I don't know if you saw it, but we saw some big moves in all of these stocks. But ServiceNow had the biggest. But you know what? Not cheap. I'm willing to give Adobe a pass because it's so profitable. It sells for less than 30 times next year's earnings estimates, and that's fine by me. I like ServiceNow, but there are no extenuating circumstances this year. It trades at 61 times earnings. It's not going to make it. Twilio is a borderline case. It's trading right at 10 times earnings, but given its fabulous Rule of 40 score, I say we let it stay in this group. As for the cloud princes of the remaining names, both Atlassian and Coupa Software both trade at well more than 15 times sales. That leaves HubSpot as the only prince, passes both tests. HubSpot. Wow. Okay, how about the cloud commoners? Only Five9, RingCentral, and Zendesk trade at less than 10 times next year's sales. So we've got to be careful with the rest of them. Finally, you've got remaining the IPOs, CrowdStrike, Zoom Video, and Dynatrace. But CrowdStrike and Zoom are still ultra expensive, trading at more than 20 times next year's sales. I don't feel comfortable recommending that to you at this environment. Bottom line, when you try to be objective about the cloud stocks, the ones that you want to keep are Adobe, Salesforce, Splunk, Twilio, VMware, Workday, HubSpot, Five9, RingCentral, Zendesk, and Dynatrace. Everything else, what can I say? You need to be a lot more cautious, perhaps more subjective, and that's not the best way to invest. Hey, got your list. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.